Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Hello and good morning. Welcome to Wealth Coffee Chats Tax Edition. I hope you all have your favourite morning beverage in hand. My name is Kim Wolfenden. I'm part of the team at Positive Tax Solutions. I am a former property lawyer and property investor, both in Australia and more recently overseas. Many PRE clients that reach out to Pos Tax for help with their tax accounting have questions about their house and land packages, what they can and can't claim as tax deductions. This confusion is very understandable because the ATO has been a bit back and forth on the rules. Now, obviously here we're only talking about house and land bought for investment purposes, because if your intention is to live in the property once the building is constructed, like once the residence is finished, then none of the costs are tax deductible anyway. As we go through this, I will briefly mention some exceptions to the general rules because there always are exceptions, and these relate to other ownership entities, business use of vacant land and farmland. But otherwise, I'm going to keep this discussion focused on individual ownership for property investment. So let's explore that a bit today. Let's take a dive into the tax deductibility of interest and other holding costs related to house and land bought by individuals for investment purposes. Now, I mentioned that the ATO had been a bit back and forth on the rules. But since 1 July 2019, it's pretty clear that most people can't claim tax deductions for the holding costs of vacant land. There's a few definitions related to this topic, and the first one is, what are holding costs? That means things like loan interest, so the loan you took out to buy the vacant land, the interest on that loan, council rates, land tax, and maintenance on the bare block of land. These are not deductible anymore unless you fall into the fairly narrow exceptions that I mentioned. Before 2019, it was different. You could often claim those costs if you intended to rent the property out. Let's take a very quick look at the exceptions to the general rule, which I mentioned. Businesses, if the land is genuinely used in a business, say farming or running a nursery, then deductions for holding costs can still apply. Certain ownership entities, companies, managed investment trusts, and non-self-managed super funds can still claim. And primary producers, so farmers with land use for agriculture, are generally also safe. But if you are just someone holding a block to build a rental property one day, that's when these restrictions on claiming holding costs apply. Another definition we need to look at is, what is vacant land? And again, a reminder, what I'm about to run through mainly applies to individual investors. So you're a typical mum and dad investor who's bought a block and you're waiting to build, or you're mid-construction, or you're wondering whether that shed or tiny house you put on it makes a difference. This information is for you. So land is considered vacant if either it doesn't have a substantial or permanent structure on it, or you have built a substantial or permanent residential structure since you own the land, but it is not yet legally occupiable or not yet available for rent. So there's nothing on the land, or you built a residence but you haven't yet got the occupation certificate, or it still needs work before it can be occupied, or it's finished but not yet rented or genuinely available for rent. So you might be thinking, ways around this. Maybe I could just whack on a tiny home and rent it out, so I could claim the holding costs until I build the actual residence. Be careful. Let's take a look at what does and doesn't count as a substantial and permanent structure. Things like a fence, a retaining wall, or a garden shed, they don't cut it. The ATO would still call the land vacant. Let's look at perhaps a tiny house example, because this can get a little bit more complicated. If you've just got a tiny house on wheels, like one of those tiny houses that you can pull in on a trailer and pull out again, so they're movable, that doesn't count as a permanent structure. So for tax purposes, the land is still considered vacant. But what if you have a prefab tiny home with proper foundations, that's got council approval, that's connected to the sewer, it's connected to plumbing and electricity? That's different. That would be considered a substantial and permanent structure and lawfully occupiable. So once you've made it available for rent, the land would no longer be considered vacant. So the big test is it permanent? Is it income ready? If not, the land is still considered vacant in the ATO's eyes, and you can't claim the holding costs of the land. Once you've got that house ready to be rented, though, you need to be very careful with apportioning expenses. Maybe an example would be useful. Let's look at an example of how to apportion holding costs once the property is rent ready. Let's say Samantha builds a rental house that's completed and ready to be rented on 1 December. So from 1 December, the land is no longer considered vacant. She's been paying interest on a loan that she had to take out to buy the land, and she's also been paying council rates on that land. Since the land was considered vacant for the period 1 December before it was ready to be rented, she can't claim any of the interest on the loan to buy the land or the council rates before that date. But from 1 December onwards, the land is rent ready and no longer considered vacant. So both the loan interest and the council rates become tax deductible. The good news is that the amount that she can't claim as a deductible expense, so the holding cost prior to 1 December, she can add to the cost base of the property, which would be relevant for capital gains tax purposes. But what about the interest on the loan that Samantha took out to finance the construction of her investment property? This is treated differently to holding costs of vacant land. The good news is that if she set it up correctly, Samantha can claim a deduction for interest on the loan that she took out to fund the construction. And here's why. When the ATO changed the rules in 2019, they said you generally can't claim holding costs for vacant land. So that's the loan interest on the land component, council rates and maintenance for the vacant block. But they carved out a special exception. Interest on a loan that's used to actually finance the construction of a rental property is not considered a holding cost of vacant land. That means it's deductible even while you're building. Of course, there's a couple of things to watch out for, as always. If your loan is a mixed loan, so part of it is for buying the land and part of it is for the construction, then you need to apportion. You can only claim that part that relates to construction. The construction portion is deductible, but the land purchase portion is not, while the land is still considered vacant. And remember, the deductions apply because the borrowing for the construction is directly linked to producing assessable income. And that's the rental property that you're working towards. So to wrap up, the key takeaways for today, land loan interest, usually not deductible until the property is income producing. Construction loan interest, deductible because it's specifically excluded from the definition of holding costs of vacant land. That's it for today's episode of Wealth Coffee Chats Tax Edition. Thanks so much for joining in. If you found this information helpful, maybe share it with a friend who's building or investing. And as always, if you are unsure, please seek advice from a tax professional. So until next time, happy investing.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.